This episode is brought to you by Affinity, the most trusted CRM for private capital.
Hello and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Marianne Azevedo, and this is the episode where we bring on industry experts to help us explore a trend in the tech world and dive deep. Today, we're joined by Mark Goldberg, founder and GP at Chemistry. Mark, welcome to the show. It's not your first time, but it has been a little while, a couple of years, right?
A couple of years and a new fund, and it's great to be here, Marianne. Thanks for having me.
Yeah, thrilled to have you back. I know a lot has happened since we last spoke. For one, you left Index Ventures after many years to help start this new firm called Chemistry with Kristina, Shen, and Ethan, is it Kurzweil? Is that pronouncing his name correctly?
That's correct. You got it. You nailed it. Yep.
Okay. So now you were at Index for about 9 years. While you were there, you invested in some fintech companies, to say the least, such as Plaid, Persona, Lithic, and Pilot. But I'd like to hear more about Chemistry. I know a few things. It's a $350 million early stage fund. I'd like to know more about your actual investment thesis, though.
Well, first off, it's great to be here and talking to you in this context. We are about to hit our 6-month milestone as a new fund, corresponding almost exactly with, we just had a third kid 3 weeks ago, so I'm just back from paternity leave. So no small amount of things going on between the new fund and 3 kids under 5 at home. But this is the most fun I've ever had professionally. And even though it's busy, it's a blast.
Wait a minute. Did you just say 3 kids under 5?
That is correct.
Wow.
That is correct. So not as much time for hobbies as I used to, but a lot of fun.
Actually, when we talk about a new fund or we talk about 3 kids under 5, it's the 3 kids under 5 that has me most daunted. Anyway, you're a hero.
Well, we're having a lot of fun. And it's so on the new fund, you mentioned Kristina and Ethan. We've been longtime friends and have worked on many investments together over the years. We had this shared ethos that we could create a new product in the market where we, instead of going big like many of the large multi-stage funds have did, we could go small and boutique and really focus on the alignment between founders and investors at the early stage. Between the 3 of us, we had made over 100 investments. We've been on over 50 boards. And we felt like we could bring that experience with a combination of hustle, feeling like we have the founder itch and 2 decades, 3 decades in front of us to build a new platform where we could really just focus and go all in with folks at the early stage. And so we lead seed, we lead Series A, and our strategy and our pitch to founders is we have this experience from 40 years on some of the biggest platforms in the world. But as of 6 months ago, had 0. Now we have 6 investments. We actually signed our 6th term sheet this morning, but we have really clean slates to be able to go do a natural work for our portfolio companies and to work directly with our whole team, which is something we're very excited about.
Yeah, you've been described as being part of this kind of a new guard of venture capital, this cohort of VCs that it's over the past year or two, it feels like a lot of investors have decided to do the very same thing that you did, leave a large firm, start something more boutique. I think it does speak to the evolving nature of the venture industry. How would you say it's different investing in this capacity compared to before? And are you competing with your former employer on deals against them, rather? I don't know, or competing with them on deals?
Well, I think what we're seeing, if you kind of look at the macro, is this institutionalization of the asset class. When venture capital started decades ago, it looked a lot like what chemistry is, these small partnerships, equal partnerships, this very bespoke approach to doing the job. And what we've seen from the last 10 years is this race to grow AUM, to grow the breadth of offerings to founders, not just to do early and late stage, not just to do venture capital, but to do private equity and roll-ups with tech enablement and all these things. And so we've seen a consolidation of the biggest players grow. And I wouldn't be surprised if in the next 12 to 24 months, we see one of these historical venture funds become a public company that is really an asset manager, much in the same way that some of the large private equity funds evolved over the 90s into the 2000s. We wanted to create a point of contrast, and I don't think we're alone in that sense. There are many people, this is probably the most dynamic time in the industry to be a founder, to be a venture capitalist in the last 25 years. And we think this point of contrast towards that institutionalization is that smaller partnership where we don't make that many investments, but when we do, we have this capacity to be able to work very closely with our teams.
So you're focused on quality over quantity, and it sounds like you want to be more hands-on. Would you say you're able to be more hands-on now?
Yeah, if I could show you my where I'm sitting right now, all three of us were working in very fancy offices before, but now we're in a converted garage in South Park. And that's very much the ethos that we're bringing to the ecosystem, which is the sense of grit and hustle combined with that experience we brought. And I think that's the pitch that we're seeing resonate in the market. There's a lot of great funds. There's a lot of great VCs out there. We think we're bringing something a little bit different, which is this focus and teamwork and alignment to really, your success is our success in this portfolio.
How do you think founders are reacting to that when it comes to deals?
So far, we've been very happy with the results of the first 6 months. As I said before, we've done a bunch of deals. We have a team of 10 people now. We've got an office that's kind of bustling with energy. We're out in the ecosystem 4 or 5 nights a week. So we're feeling it resonate. But we're a new brand. We're, I think, probably better known for our personal brands and the fund brand. And the opportunity for us is to hopefully build a fund brand that stands for excellence at the early stage. That's what we wake up every morning driven to do. And this is the most fun I've had professionally trying to do that. And I think some things we're doing well, some things we have to get better at. But the fact that we get to come in here every day and think about how do we make a founder experience from first principles that we're really proud of is a real pleasure.
Now, when you were at Index, you were focused on fintech. Is Chemistry a fintech focused firm, or do you invest across sectors?
We just want to find exceptional companies at the early stage. So we don't have a sector focus. We all bring majors to our sectoral map. So I've done a lot in fintech and software. Ethan's done a lot of developer infrastructure, some great businesses. Kristina's done a tremendous amount of vertical software. So I would say each of us brings a kind of Rolodex of experience and portfolio companies, but we're really just trying to find outstanding companies. I'm still looking very hard at the fintech landscape, but it's not the focus of the fund. It's not the singular focus of the fund.
Got it. So I know that our last conversation, you famously described 2021 as the party and 2022 as the hangover, which I felt resonated with all of us because it very much felt that way. It was a superb analogy. And I just pictured it in my head, lots of people dancing, going crazy, wild, and, and then hangover, people just kind of slumped over oh my gosh, what have we done? Then you described 2023 as at least fintech's Noah Ark year. What about 2024? And I'm curious what you think we have in store for 2025. So, at least on my end, I'm seeing a lot more deals closing and happening. I'm getting pitched, I would say, significantly more this year, even than last. Even though I know AI is getting the bulk of attention, fintech is still seeing a big uptick. But what are you seeing?
So first off, thank you for giving me the evolution of the last few years through quotes here. And what I would say is it's such an interesting moment, right? Where there's so many tailwinds behind fintech. And the tailwinds that I see are the public markets are receiving our companies well in the fintech ecosystem. There's more infrastructure to build in this category with companies like Plaid and Lithic, Persona, Unit. Many of the building blocks are there to build. You see large scale M&A, the bridge transaction with Stripe at the end of last year. So there's a lot of momentum behind the space. On the other hand, I almost feel like this is a rebrand opportunity for fintech, and that this might end up being the rebrand year where the vast majority of pitches I hear in fintech today are more techfin than they are fintech. And let me explain that. In the past, what I've seen in fintech is lending and payments and wealth management and capital markets. And what I see today, 90% of the time, is people saying, I'm an AI technology company that is pointing my products and solutions at financial services as an end market. And that is the vast majority of pitches I get. So I'm a customer support business that serves banks. I am a KYC company that is working with fintechs. And I say, are you a fintech founder? And they say, no, I'm an AI company. I just happen to sell into this market. So it's an interesting inflection point where if you look back over the journey, fintech went from being narrow to extremely broad. If you think about embedded fintech, which was a great concept from the last 3-4 years, it kind of made everything fintech. And now I think we're in this interesting moment where we have yet another chance to redefine the umbrella. And I think we're seeing a lot more of the techfin than the fintech.
That's an interesting way to describe it, techfin. And I could see your point. There's a lot of infrastructure that keeps coming up. But when it, last year, for example, you bring up the embedded fintech, and we saw some struggles, especially when it came to banking as a service companies. We saw the collapse of Synapse, and then this year, Solid went bankrupt. How do you think all that has impacted the sector?
I think fintech stands in contrast to the Facebook concept of move fast and break things. We are now seeing the fallout from businesses that took a direction of let's go, 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 and not think about the impact on everyday consumers. What you're describing is really sad, and not for the VCs and investors and operators that might have been impacted, but by the consumers themselves that were left in the lurch, thinking that there was more stability in these products than they understood. I think we're also entering a very deregulated market, which is probably a boon for fintech, but might not be so for consumers, where you're taking the guardrails off, and that probably is going to spur a lot of growth and innovation in this category. But I worry about the impact on consumers, and I think that entrepreneurs are going to be very thoughtful about how they build in this new chapter.
I hope so. I agree with you. I felt really bad for these people. I was getting emails from all sorts of customers of fintechs that were working with these vast companies who were saying things like, my teenager put $3,000 in this company that he had saved working a couple of years for, and then they couldn't access the money. There are real people being impacted by that. And it's really not fair when you see companies just moving ahead at kind of like at all costs, thinking, oh, well, so what if we don't follow the rules exactly? If we're not as compliant as we should be, we've got to beat this, we've got to beat that. And in the end, it's these people, these consumers, these everyday folks who are paying the price. And that actually angers me. It really, really upsets me. So I hope we don't see more of that. I was hoping the opposite would happen, that people would say, oh my gosh, look what happened. We have to work harder. We have to be more compliant. We have to be more careful. We need to protect these consumers, because otherwise, if more of this keeps happening, consumers are going to run away. They're going to be scared of fintechs. And even though the traditional banks might have fees or this and that, they're going to feel safer. So I too worry. So I feel like we're a little bit on the same page there. Sorry if I got on a rant.
Not at all. And I'm encouraged by what I see, which is this sense of responsibility in this new chapter. At least a lot of the founders I'm interacting with have a very strong perception of the right way to go construct new products and services for consumers. Hopefully we internalize some of the lessons from the last few years.
Good. Yeah, I hope so. I really, really hope that people learn and take those lessons moving forward.
In the business of private capital, managing professional relationships can make or break deals, which is why Affinity's relationship intelligence platform automatically analyzes your team's network of connections across all communications channels. Affinity is used globally by over 3,000 firms and is the most trusted customer relationship management system for private capital. Their new AI-powered tool, Deal Assist, enables teams to converse directly with their Affinity CRM data to uncover new insights, which means less time entering data and more time doing what we want to be doing, finding and closing deals. See how Affinity can streamline your deal-making process at affinity.co.
So you mentioned AI, and of course we can't have a conversation about investing these days without talking about AI. And you also mentioned how there was a time a few years ago where it was like, oh, every company's a fintech because everyone wanted to somehow embed payments or some type of fintech into their offerings. Now it feels like it's AI. Every company's trying to incorporate AI somehow, some more successfully than others. I'm sure you run into this. And every time I talk to an investor, I feel like we have the same sort of conversation. I'm being pitched companies claiming that, oh, we're doing AI, and you too. And it's like, wait a minute. How many of them are actually using AI in a meaningful way, or are they just kind of saying it so you'll pay attention to them? And then another thing, when we talked earlier this year, you had mentioned that you felt AI was playing an interesting role in the fintech ecosystem and that it was both creating and fighting fraud. So I know I threw it a lot at you, but your thoughts?
Let's talk about just AI and financial services. I think what we're seeing is a fundamental replatforming of the industry. And it kind of goes back to this concept of tech companies eating workflows in banks, whether that's customer support, companies like Decagon, identity companies like Persona, the rote processes inside of banks. I think we are going to see a lot of automation there, a lot of personalization there. And that is exciting. I think companies like Klarna that have gone out publicly and said, we're dramatically reducing headcount to streamline automation with AI. Companies like Shopify that have talked about backfilling headcount with automation. These are real concepts. On the other hand, I hear what you're saying, which is there's so much AI whitewashing in terms of the value being delivered. And I think we're actually starting to get to what I would call like a put up, shut up moment in AI, where you no longer can just tout the features of AI. Like you have to deliver real value. Ironically, one of the areas where we're seeing the most value delivered is to bad actors in fraud. It has never been a better time to be a fraudster. And if you look at even Stripe's annual report from 2024, they talk about the growing rise of fraud as a problem for banks, for financial institutions, and the professionalization of the fraudsters, and how these are teams with data scientists and sophisticated attackers that will try to attack on the weekends when they believe fraud prevention teams are at home. So this is an industry that has taken AI as a tool and weaponized it against institutions. And we're seeing those fraud rates go up inside of banks. So what I think we'll see in the next 6 months, in the next 12 months, is this cat and mouse game play out, where the fraudsters kind of opportunistically jumped on this technology and have used it to weaponize and to improve their attack vectors inside of banks, which have always been a great target for fraudsters. And we're now seeing the counter wave of companies come back and say, we can help you fight that. I think that's kind of the struggle. I don't know that we'll see a Hollywood movie. I'm not sure if it's sexy enough for that, but we certainly, from my seat as an investor that looks a lot at the space and watching closely.
Yeah, a lot of irony. You're right. It's like, okay, AI's kind of helped exacerbate this problem, so we're going to use AI to fight it. The fact that we're seeing more and more fraud is not a surprise at all. I keep hearing of all sorts of crazy instances of fraud, just in general. Do you think AI really has the ability to fight this from happening? Because I think that fintechs and big banks, everyone, they're just really vulnerable to this.
So as with many arms races, I don't think there will be a definitive winner in the fraud versus anti-fraud camp. We're going to see the push and pull. What I'm seeing on the good actor side is companies like a former portfolio company of mine, Persona, that is really the leading prevention tool on the identity verification side, say it's never been harder to understand who is who they say they are online and to start to create parameters to make it easy to build that trust in users again. I think that is a very powerful tool at a moment that is really crying out for it. And Persona is one of many companies that are going to be on the solution side of this. I am an optimist. You might even be able to tell that from our conversations over the years, but I'm very optimistic that the fraudsters will not have an edge, that the companies creating the tools will be able to put fraud in a box. But I think it's worth recognizing that more and more content, more and more transactions will come from non-human identities, and we need to have tools and recognition to fight that.
What other areas of fintech do you think are exciting these days?
I think we are in a period of what I'll call Fintech Maximalism. And by that, I mean the companies that grew up in the last 5 to 10 years in fintech that quietly executed through the winter of the 2021 to 2024 period have emerged as these compounders in a way that has really taken my breath away. I would contrast it with companies like traditional SaaS businesses, where they generally follow a S-curve in growth. Maybe they can quickly get to 50 million in revenue, 100 million in revenue, 200 million in revenue, and then they generally hit a plateau where they have to reinvent themselves to break free. Fintech is a very different shape of business, which is what we're starting to see right now. We're starting to see how hard it is to hit escape velocity as a fintech. I mean, many fintech companies did not survive the last few years, or if they survived, they're on life support. But the ones that reached scale, kept their head down and executed, Chime, Plaid, Stripe, Revolut, Nubank, have the ability to be hundreds of millions or billions of dollars in revenue and to double every year. And so the depth of these markets has surprised me. It probably shouldn't have, because financial services is what, 20% of GDP in the world. But it's different in a way where I think we're going to see some of those winners from the previous generation of fintechs be able to compound. And if we were to look 10 years later, I wouldn't be as surprised to see 10x growth from some of these companies. I also think that what's going to happen is fintech is in this accordion for the last 15 years of unbundling and rebundling. And we're clearly in the rebundling phase. And if you look at products like Robinhood Gold or Revolut Metal, they're basically subscription products for the kitchen sink of financial services. I think probably the best analogy is like an Amazon Prime, where you pay your monthly subscription fee and you get this kind of grab bag of perks. And we're starting to see that business model come to consumer finance and do it in a way that I think is very compelling to the average consumer. I think that Robinhood just launched in their Robinhood Gold a product where you can get cash delivered to your door, ATM brought to you. I mean, it's flashy. I'm not sure how many people will see the value, but it's impressive in terms of the ability to keep innovating at that scale in a way that has surprised me. So I think we're in this period, again, back to this concept of like fintech maximalism, where the people that quietly executed well through the last few years are emerging with tremendous speed, execution, and ability to kind of go cross product in a way that's going to benefit consumers, I think.
One thing that I feel like I've been seeing a lot of in this space and just overall is M&As picking up. I'm getting a lot more pitches for this company's buying that company and this company's buying that company. And I know we've also talked about that, like predicting more consolidation. We don't always hear about it. It's probably happening quietly behind the scenes a lot more than we even realize. But what do you think? Are you seeing, or do you think we're going to see more M&A this year?
I think we will see more M&A this year, but I think we will see more quiet M&A that suggests not necessarily the best outcomes for some of these fintechs. I don't think a lot of the companies that raised at unicorn valuations in 2020, 2021 are anywhere near the valuations that they were at that point. As such, we're seeing almost this zombie scenario play out where these companies, when the growth rate slows down, they have a hard time retaining talent. They have a hard time justifying the preference stack of investment dollars that have been put in. And while it doesn't necessarily kill the company, it makes it much harder to thrive. And those businesses are the ones that I think will be prime targets for consolidation at lower multiples than I think founders, employees, and venture capitalists expected. But it will help clean up kind of the sprawl in financial service and fintech that we saw over the last 5 years.
Yeah, I feel like we saw this flurry of many companies in the same space, and it was just a little too much. You also mentioned companies like Klarna, Chime, and these are among the companies we thought would be going public this year, right? Up until just last week or 2 weeks ago. And then all of a sudden it was like, wow, this is the year of the fintech IPO or IPOs in general. Klarna, Chime, whoa, we're so excited. And what does this mean? Who else is going to go public? It's a new chapter. Well, then boom, like everything came to a halt. What do you think about that? I mean, do you think they were scared away for a while now because of these tariffs or what's next?
I think the people holding their breath for the fintech IPOs this year are going to be blue in the face. I think we are not going to see IPOs for, the hope that people had around these near public companies. It's coming, but I don't see it as a near-term event. Clearly, the macro volatility makes it nearly impossible for these businesses to go out. But I think more fundamentally, many of these companies are choosing to stay private and deciding that the public markets are not the promised land that they would have thought of 5 years ago, 10 years ago. It really impacts the entire value chain in venture capital when you see these companies deciding to do this. What's more likely is we will see late stage rounds that create liquidity for existing shareholders and investors to relieve the pressure valve on the public markets. I am not somebody who thinks that we will see a flood of IPOs in fintech or the broader tech ecosystem in the next 12 months.
Yeah, I probably agree with you there. Now, and you mentioned these companies trying to or working to give, say, earlier employees liquidity. I know we've seen a lot of secondary sales this year, including Stripe. I know Plaid, their most recent transaction, and they wouldn't describe it as secondary, but it was in part to give back some liquidity. Ramp too. I mean, we've seen a lot of these larger players do that. And one question that keeps coming up is well, if a company like Stripe, valued at over $90 billion, is doing so well as a private company, why would it go public? What does that mean for investors, though? I don't see Stripe getting acquired. So how is a company like that going to exit in a way that makes it pay off for its investors?
I think we're going to see new products created for liquidity in the private markets. So I wouldn't be surprised if we see a wave of innovation around secondary funds that go to try to create liquidity to be able to give some of those early shareholders, whether that's employees, whether that's early VCs, liquidity. We've seen attempts at this over the last year, 2, 3 years, but I think we are on the cusp of innovation in the capital markets on that side to account for the fact that these companies are deciding not to go out for the public path. And I think this is normal. I think what we see is innovation in capital markets all the time. I was an investment banker 16 years ago to date myself, and we were talking about innovative structures then, and that through line exists. And I believe that we will see liquidity even if it doesn't come from the public markets.
Yeah, that's interesting. I'm really curious to see how that all plays out because I do think we have quite a few companies, not just in fintech, as you pointed out, that are in that position of, we're doing really well. I don't really see the point. In fact, it almost seems like it might harm things if we decide to go public. So I'm curious to see how that plays out. Overall, what do you think we should be expecting venture-wise? Do you see more people starting boutique firms like Chemistry? I've been hearing a lot of, especially when it comes to AI, these crazy valuations for pre-product companies and massive secondaries where these founders are cashing in really early and they haven't even got a product. It's starting to feel like 2021 again in some ways, especially because it's this AI-driven mania.
Yeah.
What do you think? Are we facing that or are we going to learn from our previous mistakes there too?
I certainly hope so, but we are certainly seeing some what I would call vibe investing going on, where we are seeing rounds get done, especially kind of at the red hot center of AI, in teams that everybody respects that are reaching 2021 mania pricing. People are chasing the promise, and there'll be a lot of blood in the water when all is said and done, but there will be some great companies that are born now, and investors are weighing those two factors and making decisions. In terms of the broader ecosystem, I do not expect we are going to see a lot of new funds like Chemistry emerge. I think it's a very difficult funding environment for new managers, especially with the public markets volatility. I think there's a lot of institutional LPs that are really re-underwriting the asset class of venture capital, which means that we will see a more controlled flow of money into the space. For what it's worth, I think that's a great thing for the asset class, and we will see some of the shakeout in terms of who is here as permanent capital and who is not. I think it's a great thing for founders, and I think we are seeing, from my seat where every day I'm meeting with early stage founders, we're seeing more founders than ever. So clearly, this is not impacting the pace at which people are starting new businesses. In some ways, I've seen that accelerate in the last year. But I'm really focused on the early stages. I think where you're going to see the impact is these mid-stage companies, these late-stage companies that are closer to the volatility in the public markets. That's where the real impact is going to be.
It's interesting. Well, I know we're almost out of time, but I just wanted to kind of end this on a little bit more of a fun note.
Sure.
I saw in one of your bios that you like to play chess and you like to surf. So how would you compare investing to one of those things, either playing chess or surfing? And I know I'm catching you like off guard, but.
No, I love the question. And I have to own up to the fact that while I'm playing a lot of chess, I am terrible at it relative to all the founders that I end up talking to. So I won't disclose my elo on the show, but I would say I'm an avid but mediocre chess player. And in surfing, I think that's probably the better analogy. So much of technology investing is getting behind the right waves of innovation. And I think being able to understand how to position yourself, how to kind of get behind the founders who are seeing kind of in the distance these waves come up is very relevant to how I think about my day job as an early stage VC. And what I would say is there's a shocking confluence of people on the founder side that are interested in surfing now that I can hopefully help marry that analogy to. So
That's awesome. It's always so much fun talking to you, Mark. It went by so fast. Thank you so much for joining us on the show. Where can our listeners connect with you or find your work online?
Well, thank you again for having me. It's such a pleasure to do the show with you again. Please have your listeners reach out to me on Twitter, on LinkedIn. I'll be happy to talk to them.
What's your handle on Twitter or X?
Mark_Goldberg.
Okay.
Maybe we can put it in the show notes. So.
Okay. Yeah. No, thanks again. And listeners, you can find me at Bay Area Writer on X and Equity at Equity Pod. Thank you so much for listening. See you next time.
Equity is produced by Theresa Loconsolo with editing by Kell. We'd also like to thank TechCrunch's audience development team. Thank you so much for listening, and we'll talk to you next time.